Do you ever feel like you've overcomplicated your trading? If you think back to when you first came to the markets and you first looked at a chart, maybe you started demo trading, maybe you were paper trading, maybe you were just sort of casting an eye over the charts and trying to make a prediction on which way the markets were going to go. And more often than not, you were right or you were making money in your demo account. And then what happened was you decided to get a little bit more educated. So you decided to read some books, you decided to start looking at some strategies. And what happened was that ultimately your trading deteriorated. So you were not as profitable, you were not as consistent as you were when you first entered the markets. And sure, you didn't have the knowledge of how to control risk and things like that. So obviously you do need to educate yourself a certain amount. But ultimately, you find that the more you learn, perhaps sort of like the less effective you become in your trading. And that happens to everybody because what we do as traders, we feel that, the more complicated the system, the better it's going to be. The more that we can fine tune our entries, the better we're going to be. But what I want to do in this video right here is I want to teach you a strategy. It's a very laid back strategy, and it's one that's perfect for those of you, that have a 9-to-5 job or have other commitments in the day, or perhaps you don't want to spend all of your time during the day watching the markets and watching the charts and things like that. So you might like a bit of a passive, a laid back strategy that would allow you to look at your charts for maybe half an hour of an evening and pick your trades during those half an hours of the evening, and then just kind of leaving your trades to run and letting your trades either hit their profit targets or hit their stop loss, but ultimately allow you to make money in a very passive way. So you're not sort of focusing too much time and attention to the markets. Now, sure, there are going to be some of you guys who are market junkies who love the charts and you want to sit there for 8 hours a day, and that's absolutely fine. But I also understand that there's a number of you that just want a way to supplement your income. You just want that passive sort of approach that can put an extra few pounds or dollars in your pocket every day, every week, every month, whatever it is. And ultimately, this strategy is going to be perfect for that. And it's going to be stripping things back a little bit. So it doesn't have all of the bells and whistles that other strategies might have, but it is still very effective and it is still very consistent. It's going to put profits into your trading account. Okay, so that's what we're going to do in this video here. But before we do get into the nitty gritty of it, please make sure that you are subscribed to my channel. So if you haven't already done so, click that little red subscribe button and also hit the bell so that you get a notification as and when I release a new video. Okay? All right, so let's talk about the strategy that I'm going to teach you today. Well, as I've already said, it is a passive strategy. It is laid back. It's based primarily off of price action. Although if you want to incorporate, longer term fundamentals, and I'm always an advocate of that. So if you have a way of looking at the overall direction of the market, looking at, fundamentals like interest rates, employment numbers, and other things of that nature, then that's absolutely fine. And that's only going to enhance what I'm going to teach you here. But if you don't incorporate that, then what I'm going to teach you is still going to be effective. It's still going to make you money and ultimately, obviously, make you long-term consistently profitable. Okay? So what we're going to be doing for this strategy is we're going to look at the daily charts. And I'll show you when we get over to the charts in a moment. But the indicators that we have on our charts, they're just two of them. So it's very simple. We're going to have the 100 period moving average, and we're going to have the 10 period moving average. The 100 period moving average is one that's it's widely accepted as being one of those moving averages that allows you to identify the overall direction and the trend of the markets. So a lot of professional and institutional traders utilize this to give them a bit of context around the markets. And the 10 period exponential moving average is one that I took from a book written by Marty Schwartz. He was in the Market Wizards book. He also wrote his own book called Pitbull. It's a great book. I've spoken about it a lot on this channel. So if you haven't already read it, please go and read that book. But the 10 period moving average is an indicator that he uses to help him understand where the daily momentum is. So which way is the market most likely going to trade for that particular day? And what we're going to do is we're going to use a combination of the 100 period moving average for context, the 10 period moving average for the sort of the daily momentum and the intraday direction. And that's how we're going to come to our trading decisions. Okay. But with that being said, let's jump over to the charts because I think it's going to be more obvious what we're talking about here if we jump over to the charts and we look at the actual trade setups, the entries, how you're going to get into them, where you're potentially going to place your stop losses, and obviously also where you're going to place your profit targets. Okay, so let's jump over to charts right now and see what we have cooking. So the chart we have in front of us is an Aussie yen chart, and it's on the daily time frame. And as you can see here, we've got the two moving averages, so the exponential moving averages that I just mentioned. So we've got the 100 moving average, which is this orange line here. And then the blue line is a 10-period moving average. And the rules are very, very simple. When the blue line is above the orange line, we're looking for opportunities to buy the market. Okay, so that's the first thing. When it comes to trading, we've got to break it down into a few different sections. So the first part is to really identify which directions you want to be trading in. Once you understand what direction you want to trade in, then you can kind of nail it down and look at your entries. But the first thing is to understand, a bit of the context behind the markets that we're trading in, to understand really which direction is it that we want to be trading in. Because if the market is moving upwards and you're trying to sell it, that's going to make your life a hell of a lot more difficult than if the market is moving upwards and you're trying to buy it. So the first thing we need to do is get an idea as to the overall direction of the market. And to do that, we use the moving averages. So the 10-period moving average being above the 100-period moving average lets us know that the market is in a bullish state. So we're most likely to make money if we're buying in this market. If the 10-period moving average is below the 100, so like it is here, then we know that the market is in a bearish state, and we're going to have the highest probability chance of making money if we were to sell the market. All right. And what I want you to do is to really sort of pay attention as to what the market does when the moving average is below. So the 10's below the 100, and when it's above the 100, you should see that the general direction of the market, regardless of the market that you're trading, is in that direction. So with the 10 above the 100, generally, the market is moving up. It's not to say that there isn't a down day there, but generally speaking, the market is moving to the upside. And when the moving average is below the 100, then the market is making lower lows. All right. In this case here, it only did it very temporarily. Then the market broke up and it continued moving up. That would have been an instance where you probably would have taken a loss right there. But what we have to understand is that we're not going to avoid trading losses, right? That's not the point of this system. The point's to be able to, or it's not the point of trading in general, actually. We're going to take losses, but what we want to do is overall, we want to put ourselves in a position where we're winning or we're making more money than we're losing, and hence we're net profitable. Okay, so this obviously would have been a losing trade, but then the market jumps up above it. And what I want you to sort of look at and pay attention to is the fact that when the market is above, so the 10-period moving average is above the 100, and the price, so these candles are above the 10-period moving average, kind of look at what happens. The market just sort of, yes, it goes sideways a little bit, but generally the overall direction is up. So had you been a buyer, had you bought this market anywhere between, let's say, this period here on the 9th of November, all the way up until the present day, really, had you bought the market anywhere in those sorts of times, more often than not, you actually would have made money. And that's without, overcomplicating things. That's without sort of looking at your stop losses, your take profits, or anything like that. Just stripping things back and going really, really simple. So as I said, going back to what you were doing when you first came to the markets, which is just try to pick the overall direction of the market. And you can see that essentially, if you're able to do this, so using the moving averages that we've got here, which is two very, very simple indicators, and then looking at the overall price direction without getting any more sophisticated, you can see that if you buy in this market here, more often than not, you're going to make money. Now, of course, we need to put in some risk management parameters. We need to understand where we're going to have a stop loss in case we get shaken out of this market. So if the market goes against us, how do we limit our risk and how are we going to take profit? Okay, so now let's look at the sort of entry of this strategy here. So the context again, the moving average, so the shorter moving average being above the longer one indicates that we're in a bullish market, so we want to be buying. And if it were below, so the 10 were below the 100, then we'd be in a bearish market and we would look to be selling. Now, in terms of the entry, we only enter the market if the price is above the 10-period moving average in an upwards moving market. So if the blue line is above the orange line, then we want the price. We want these daily candles here to be above the blue line. If it's below the blue line, then we don't get into a trade. We don't look to sell the market. We don't look to buy the market. We just wait until the price jumps above that blue line there. Then once it's above the blue line, we simply play a game of buying through the highs. So this here is an upwards moving market. So if we're in an upwards moving market, what we're looking for is we're looking to buy through the highs. And we don't need to overcomplicate it. We don't need any complex candlestick patterns or price patterns. We're literally just saying when the market, so let's say here, for example, when it breaks above this blue line, which it does here, then what we're going to do is we're going to buy through the most recent high. Now, that high could either be, you could say, well, you know what? If it's a bullish candle, I'd be happy to buy through the candle high, being this guy over here. Or you might be a little bit conservative and say, well, actually, I prefer the market to go break to new highs, in which case you would use this area here as being your high. And that's not actually very straight. Let's get in a line here instead. You would use this area here, and you would set an order to buy when the market gets above that level. Okay. Then in terms of your stop loss, you're going to want to, if you're not trading, we trade an active currency trader approach, which allows us to be a little bit flexible with our stop losses. But let's say you're not trading that for the moment. So you just want to go to, pure price action based strategy. Then what you would do is you'd place your stop loss somewhere below the low of the candles of the recent swing low. I wouldn't put it directly beneath here because you might get shaken out like that. I'd probably put it a little bit further down. So maybe somewhere closer to the 100 moving average in this instance, but 10, 20 pips below there. So you give the market a little bit of room, to shake back and forth, because that's what it's going to generally do. And then what we do is we literally just we look for opportunities in this upwards moving market whilst the price is above this moving average to buy through the highs. So that would be an opportunity there. Okay. We get in here again. We can see that we would have another opportunity there. We can see that again here, there's another opportunity to buy through the highs. Okay, maybe the market is already sort of moving up, so you don't want to wait for such a big sideways bit of price action there. It's also okay to literally say to yourself, well, you know what? We've got a few candles here. They've created a bit of a cluster. I'm going to buy through those highs. Okay, so we don't have the big sort of sideways price action that we did over here, or over here, or over here, but actually just based on a bullish momentum candle, then looking at the congestion that follows it, you're absolutely within your rights to buy through those highs. And again, you place your stop at logical levels. So if I bought this area here, the most recent sort of swing down probably would have been this area here. So I place my stop there. And as you can see, the market, even though it does move sideways a little bit in this area here, it doesn't come down to this low and take me out. And if I hold that position enough, I'll be able to hold it for a nice 1-to-1 reward to risk ratio. You can hold it for more if you like. So if you're someone that prefers more of like a 2-to-1 or a 3-to-1, that's absolutely fine. But if you're just going for a 1-to-1, the market goes off and pays you really quite quickly and quite nicely. And the same works in a downwards moving market. So if we were to, let's say, I don't know, let's look at the Euro Aussie recently. So the recent price action here in the Euro Aussie, when the market crossed below, and let's get rid of these support and resistance levels here. So when the market crossed below the moving average, so the 10 crossed below the 100 in this region here, this is where we would have started looking for selling opportunities. And what we would do is we would either look to sell through a low. So for example, let's say this is our first opportunity here. Okay, so we would get in somewhere around this candle here. Fine, the market moves sideways a little bit. Perhaps we put our stop over here, so we get shaken out of the market in this instance. We take a loss. You have to take a loss sometimes. That's just trading for you. And then you look for the next opportunity to get involved in the market, which again, the market closes below the 10-period moving average, indicating to us that the momentum is in the overall direction of the big trend. So we would maybe look to sell on the low of this candle here. That would take us in at this point. We would then be able to take profit relatively quickly. Again, if you want to be more conservative, maybe you don't do that. If you want to be more conservative, maybe we say we don't want to sell through that candle. We're going to wait for a period of consolidation and then sell through that consolidation. So then you get that period over here. We place our stop above the highs there. We end up getting involved in the market over here. The market moves against us a little bit, but then eventually drops through the floor and pays us very, very nicely. And if you wanted to do something a little bit more sophisticated, maybe you want to take some trend line breaks, you can absolutely do that as well. So that's completely, oops, that was a wrong indicator there. So we can take trend line breaks the same way, like you can see there. So the market breaks down very nicely and then moves in the overall direction. So it's a very powerful setup that we're using here. We're using the 10 period moving average to give us the overall direction of the momentum, and then we're using the 100 period moving average to show us the overall trend direction. And essentially what we're trying to do with this trade is that we want to trade in the direction of the overall tide. So if the tide is moving in, then we want to be moving in with the tide, and if the tide's moving out, we want to be moving out with the tide, but we're trading like the shorter term momentum moves within that. Okay, and that really is a recipe for being able to generate very consistent profits in a very passive way. Because remember, these are daily charts, so you only need to check these charts once a day. You know, if we take, for example, let's go and let's say, for example, we were trading very, very quickly here. Let's say that we were trading in this period over here, so somewhere around, let's say the 10th of February. So we came to our charts on the 10th of February here. Well, I would note that the overall direction of the market, so the 10 period moving average is below the 100, is down. The market is below, so the price is below the 10 period moving average, so momentum is to the downside. I would then say, okay, so I'm here on the 10th of February. This is the most recent low here, so I will set an order in to take me into the markets as the market breaks the low. I'll place my stop above the high there, or maybe I want it to go even further above there, completely up to you. I then go for 1-to-1 or 2-to-1, whatever's comfortable for you. And essentially the market takes you in, you don't need to do anything about it, and moves off to your profit target really very, very quickly. Okay, so that wraps it up. That's the passive income trading strategy for you. As I said, there's no bells or whistles. It's very, very simple. It's something that anybody can do. It's fairly straightforward. Yes, you need to learn to look at highs and lows and things like that. But essentially, all we're looking at here is we're looking at the moving averages to give us the context. Once we've got the moving averages to give us a context, we then look to see where price is in relation to the moving averages. And then we sell lows in a downtrend and we buy highs in an uptrend. And your trading does not need to be any more complicated than that. Okay, as I said at the beginning, if you want to add some fundamentals to give you the longer term drivers, and that will enhance the results here, but just trading this pure price-based pattern on its own is also going to yield significantly positive and consistent results for you. So I hope you enjoyed this. If you haven't subscribed to the channel, then I hope I've convinced you that subscribing to the channel is going to be a good thing. So go and hit that red button there. Also hit the bell so that you get a notification as and when I release a new video. I hope you enjoyed this, and I will see you in the very next video. Take care now.